nothing better than a little Beatles action. So we're talking about tax season right now. I mean, here we are at the beginning of February. Taxes, as we all know, are due in the middle of April. And I had two of my employees just talking to me literally 5 minutes ago about the fact that one of them just did their taxes this weekend and the other one has already started gathering up their paperwork. So it got me thinking, what is it that you need to know as a first-time home buyer during tax season? What do you get to write off? What are the advantages of owning a home with your taxes? Because so often, especially if we're W-2 employees, we really don't think about benefits during tax season. We think about headaches during tax season. I mean, come on, let's be honest. But there are some nuggets of gold, and I want to share those with you. So first off, know your standard deductions. They're quite generous, and those continue to move around depending on the administration and, of course, the focus of that administration. But right now, as a single person, you have the ability to use a $12,920 standard tax deduction. As a couple, you have higher than that. You have $25,900. And as a head of household, you have $19,400. Now, I'm not a CPA and I'm not an accountant, but I do love giving homeowners as a mortgage professional the ability to know what their benefits are during this season. So the standard deductions, and I want to kind of go through some of the things. I've got 6 tax advantages to owning a home. So a standard deduction, you can actually deduct your mortgage interest. This is a really big deal, and I'm going to go into some of the nuances, but this one is a really big deal because right now with home prices up, loan amounts are up, and interest rates are up. That means that interest can be substantial. As an example, a $700,000 loan amount at a 6% interest rate, that can be $41,000 a year in interest you get to deduct. This absolutely helps offset your ordinary income. All right. So when you purchase a home the first year, let's talk about the first year, and then we're going to talk about ongoing years, and then we're going to talk about investment properties. When you purchase a home the first year, if you bought down points to buy down your interest rate, if you paid points to buy down your interest rate, that is going to go as a deduction or an expense on your tax returns. Now, if the seller paid for it because you got a 2-1 buy down or you got a permanent buy down paid for with a seller credit, you don't get to deduct that. But if you paid for your buy down of the interest rate, you get to deduct that on the year that you purchased that home. You also get to deduct the interest that you paid from the time you purchased the home through the end of the year. Now, if you purchase at the beginning of the year, you have a lot of mortgage interest that you'll be deducting. But if you bought your home mid-year or later in the year, that number is going to be smaller and your standard deduction might take over. People think about property taxes too. In fact, this is the conversation. It does not benefit you the first year. So when you purchase a home, especially in the state of Colorado, property taxes are paid in arrears. So the seller at the closing table will have paid for the previous year in property taxes. Your property taxes as a new homeowner that year won't come due until the next year, February and June. Since that's the case, you don't get to write those off the first year. So the first year, to sum it up, we're talking about the discount points and the mortgage interest. You do not get to deduct the other closing costs, and you do not get to deduct your down payment. So on an ongoing basis, year after year, you get to deduct a full year of that mortgage interest. And again, that does add up. You also get to deduct the property taxes on an ongoing basis. What you don't get to deduct is your homeowner's insurance. So these deductions as a primary homeowner in today's market with the higher purchase prices and higher interest rates can be more than the standard deduction. When I start thinking about investment properties, it definitely moves the needle, and second homes as well. So second homes has an interesting rule. I get to deduct the interest only if I spent at least 10% of the year in that home, or at least 14 days in that home, or 10% of the amount of time I rented it out. And you can only deduct mortgage interest on one second home. So investment properties. So primary homes we talk about, second homes we talked about with a little nuance. You can only write off one second home. Investment properties is where the gold is. And I talk about this all the time because I'm so passionate about owning investment properties, not just for the appreciation and the principal reduction, but also for the tax benefits. One of the biggest benefits to owning an investment property is being able to write off depreciation. That depreciation isn't an expense that I'm feeling. It's not an expense that's coming out of my pocket. So that depreciation I get to write off every year. I'm not actually paying. So it's a ghost expense. And the IRS has determined that your home has a 27.5-year shelf life. Seems a little random, but that's where the IRS says you can write off 1/27.5 every single year. Now you can accelerate that depreciation and you can write it all off within the year or the first couple of years through a program called cost segregation. Now that acceleration could really help you out if you're trying to increase your cash flow, put some money back in your pocket during tax season in order to buy another home. But I will tell you that that's seen as an expense, not as depreciation. And there's a lot of lenders that won't let you add that back in like you can the annual depreciation expense. That cost segregation has a bigger impact when you want to go and buy your next property. So if you're considering doing it, absolutely talk to your CPA or your accountant, but also talk to your lender if you're planning on buying in the next year or two, and they're going to need your tax returns. Another benefit is the ability to do a 1031 exchange plus or minus the capital gains. So capital gains, let's talk about that. If you own an investment property for less than a year, say you're doing a fix and flip, or you buy an investment property and for one reason or another, it is not turning out or panning out the way that you had planned. That investment property, if you sell it within a year, it turns into short-term capital gains. That interest rate is higher. If you hold it for more than a year, now you're in long-term capital gains. That long-term capital gains rate is lower. So you're definitely, if you're coming up on that year, you might want to hold it for just over a year in order to move from short-term capital gains rate to the long-term capital gains rate. But one really great way to push off that capital gains, like kick the can down the road, is by using a 1031 exchange. A 1031 exchange is simply the tax code that allows you to sell one investment and purchase another. Now, it's got to be kind of a like for like, but there's a little bit of a gray zone in there. You can actually sell a single family home and buy a multifamily home. You can sell a commercial property or an interest in a commercial property and buy residential property, or vice versa. You can sell a real estate investment, actual building, a single family or multi-unit, and you can buy into a REIT, a real estate investment trust. And this is especially helpful if you're towards the end of your investing career, you are looking towards more retirement, and you don't want the active management of dealing with properties. So you can 1031 exchange and push that property, that capital gains, down the road. One of the advantages to 1031 exchange, and you definitely want to talk to your 1031 exchange advisor as well as your CPA, but if you eventually want to purchase a forever home, say you want to use, when you're younger, you want to use investment properties and you want to purchase those investment properties and have other people pay down the principal, giving you the opportunity for appreciation and principal reduction and net worth gain. So if you want to do that, and down the road, say when you're 60 years old, 70 years old, you want to take one or two of those investments that you purchased when you were younger and you want to sell them, and you want to move into maybe your forever home or that mountain cabin or something that you've really had your eye on. Well, that home, as long as you 1031 exchange and you move all of the monies from one property to the next and you rent it out for more than a year, you can convert that property after you've rented it out for a year and met the obligations of the 1031 exchange. you can convert that property into a primary home. And then once you've lived in that primary home for 2 out of the last 5 years, then those capital gains will move into your deductions for having a primary home sale should you go to sell that home down the road. That is a massive advantage of being able to wash away a lot of the capital gains. Another way right now available to us is a step up in value. Now, this could change because tax laws do change. But right now, if you pass away and in the will you give your properties to your children, they will get those properties with a step up in value, bringing those into ownership personally at whatever the current market value is, thereby removing the capital gains that might be owed based on the fact that maybe you bought the property for $600,000 20 years ago, and now it's worth 1.2. Those kids have an asset worth 1.2 and don't have the capital gains for that $600,000 gain in value. That's a massive win. You also have a home office deduction. And you can use this whether it's your primary home or you're managing investment properties. If you have a home office and maybe you're the acting property manager for your investments, or if you even work from home, you definitely want to talk to your accountant about how much of your home you're working in and does it make sense to do a home office deduction. You want to be careful because when you sell that primary home, there is some sort of clawback from those primary home office deductions. So absolutely talk to your accountant as to what is the benefit versus the cost down the road when you do sell that home. But if you're managing your rental properties and you have a home office for that management, then that is one of the costs that go into the Schedule E. And that's our final benefit that I want to talk about. The Schedule E is a massive goldmine. You are able to write off a lot of your expenses, whether it's your repair expenses, your maintenance expenses, those interest expenses, property taxes. Here on the Schedule E, I can write off my home insurance as well. So not only the interest and the property taxes like you can for a primary home, but also the insurance and the maintenance and the management and upkeep of those properties. And so say you need to purchase equipment to manage all of your properties, or you are driving and you have mileage for managing those properties. All of those things that you can deduct on your Schedule E. Writing off that cash flow coming in as rental income, grossly reducing that net income that you are then taxed on. Understanding not only the benefits of home ownership, in the appreciation, in the net worth gain, in the principal reduction, in the long-term opportunity for options, but also your ability to take advantage of the tax season that we're in right now is key. Give me a call if I can be of further assistance and help you kind of unpack some of this. And especially if you don't have a CPA or accountant and you're doing the taxes on your own and you need somebody to bounce some things off of, or if you need a recommendation for a CPA or accountant that works well with property management and owning investments in real estate, give me a call. Our team would love to go to work for you.